Glyn, April was another reasonable month for equity markets. How would you sum it up?
Yeah, it proved to be actually a reasonable month for equity markets, but there were really two driving forces behind markets in the course of the month. On the one hand, there's no doubt that the economic fundamentals pretty much globally deteriorated. On the other, there was a huge injection of liquidity from the Bank of Japan, which is on top of huge injections of liquidity from the other big central banks. So the world is sort of awash with money, and that was a sort of a competing force against the weakening fundamentals. And in the event, it was the liquidity that in April won out. So we saw developed market equities, MSCI World, up 3% or so in the month, and some markets performing extremely well. Japan was the outstanding performer yet again on the back of the Bank of Japan decision to engage in full-scale quantitative easing, so that was up over 12%. But broadly speaking, a good month for developed market equities.
Another area of the markets that hit the news was the commodity markets. Some reversals there.
Yes, well, although there was this huge amount of liquidity that was driving equity and indeed bond markets, I'll come back to that. Intriguingly, the impact of the weakening activity globally, and I think specifically in China, has impacted on commodity markets. So I know that gold hit the headlines, but behind all of that, we saw the copper price down over 6% in the month. It's down now 13% for the year. Very important barometer, of course. And other industrial metals followed in the same pattern. But there's no question that precious metals were the sort of highest profile casualty of all of this. The gold price, which peaked at $1,900 or thereabouts in the middle of 2011, had been slipping a little bit, but entered into real bear market territory in the month. In 2 days, in the middle of April, the price fell by 14%. I mean, really dramatic falls down to 1,347 was the bottom, in fact. So a big hit to the precious metals markets. And the other important thing that happened in the commodity markets was the fall in the oil price. We have felt for some time that the oil price has been too high. It's been sort of defying gravity to some extent. In the course of the month, the price fell by 6 or 7%. Only a few weeks ago, Brent crude was trading at $116 a barrel. It got down to below $100 a barrel in the course of the month, and it's broadly stayed about there. So I think that is a clear signal that conditions are slowing globally, in combination, of course, with the weakness in industrial commodity markets. And incidentally, ultimately good news for the consumer.
Weakening economic conditions might have a slightly different interpretation for the bond markets. How did they perform?
Well, I think the bond markets actually performed quite well. So we had this really quite strong environment in both developed market. I emphasise developed market equities because emerging market equities didn't participate in this yet again. And to put it in perspective, emerging markets are up just under 1% in the month. They're still down 1% for the year. That's 12% behind developed market performance. But developed market equities and bond markets did well. And in fact, if you look at the safe haven government bond markets, US, UK, Germany, the prime ones, they all returned about 1% in the month. The yields on the 10-year bonds in those markets are getting down to the all-time lows reached in the middle of last year. So that's partly driven by this flood of liquidity, and partly by the fact that we are seeing this slowdown globally in the economic fundamentals. I think what we'll continue to see, this sort of great rotation thing that people were talking about, I think that's something we don't actually subscribe to that view. We'll continue to see buyers of these bonds whilst we've got economic activity relatively weak.
Let's talk then about the new source of liquidity in the markets, the Bank of Japan. What was the main change to their approach this month?
Well, we knew the Bank of Japan, of course, was going to change policy. Since Abe became Prime Minister late last year, it's been very clear that there's going to be a change in fiscal and monetary policy. Change in leadership was immediate at the Bank of Japan. The new Governor Kuroda held his first meeting in the middle of April, and the market was sort of concerned to some degree about whether he would implement in full the sort of things that the market was looking for. In the event, I think it's fair to say that he surprised dramatically on the upside. The Bank of Japan is now engaged in arguably the loosest, the most ultra loose monetary policy of all the big four central banks. To put it in perspective, what they've decided to do on an unlimited basis is to buy assets, primarily JGB, Japanese government bonds, at the rate of 7 trillion yen per month. That's just over $70 billion per month. That's equivalent to, they're expanding their balance sheet, an amount equivalent to about 1% of GDP. If you compare that with what the Fed is doing, that's double the rate. So the Fed is buying $85 billion a month of assets. That's about 0.5% of GDP. The Bank of Japan is also going to be lengthening the maturity of its bond purchases. It's going to be buying bonds out to 40-year maturities. It's going to continue with this program on pretty much an unlimited basis with the intention of doubling the monetary base in Japan from at the moment just under 30% of GDP to about 55% over the next 2 years. In addition to that, it's actually going to be investing in other assets. It's committed to buying ETFs and J-REITs, so Japanese real estate investment trusts. No surprises then, the market continued to rise sharply after this announcement. All in all, as big a commitment as they possibly could have made to reaching this inflation target of 2% within 2 years. And of course it means now that all the big central banks are engaged in very, very loose monetary policy. The world is quite literally awash with cash. There's a tsunami of cash hitting the world, hence the rise in asset prices that we've seen this month.
Clearly the cash is there because of only moderate sort of economic conditions.
Yes.
Let's have a quick refresh on what's been going on.
Well, that I think is interesting, because what we've seen pretty much across the board is some disappointment in terms of economic activity. The US, which is still of course the most important economy in the world, has been doing better than other economies. Q1 GDP numbers came in a little bit lower than people thought, at about 2.5%. There will no doubt be some revisions to that, but that's the sort of figure that we think this economy, around about 2 to 2.5%, is growing by through the course of this year. And what we saw is, I think for the first time, quite a meaningful impact from the sort of fiscal austerity that has now been introduced into the US. So if you remember, there was the sequestration which took effect on March the 1st. That knocks 85 billion of spending, about 0.5% of GDP, off the economy. Big impact on defence, about half of that comes from defence. Defence had a negative impact of 60 basis points on Q1 GDP, quite significant. Then of course we had the other changes. The payroll tax cuts was a significant one at the beginning of the year. That's beginning to have an impact. So you've got the private sector in the US doing reasonably well. Housing continues to do well. Housing starts at the highest level since the mid-2008. And you've got business investment picking up a bit more confidence there. You've got a positive impulse from the energy market in the US. We know energy prices have been weak there because of the shale oil and gas boom. But against that, you've got this federal government spending cuts and tax increases, which are certainly having an impact. So, and the numbers coming out in April, excuse me, whether it was ISM indices, PMIs, durable goods, were all slightly on the weak side. And if you look elsewhere, Europe we know is mired in a recession. In peripheral Europe, if anything, that looks as if it's deteriorating. Purchasing manager indices there fell to really very low level, well below the critical 50 level, which is the difference between growth and shrinkage. Germany's fallen below 50. France looks as if it's in a mess. They've introduced some crazy policies under the new socialist president. That's harming the economy. So there are some concerns about Europe that it's slipping further into recession. And then I think importantly, we've seen the big Chinese economy slowing down. Q1 GDP came in at below 8%, 7.7%. The fourth quarter in a row that the growth was below 8. We've said for some time that growth rates are going to fall to a lower level, sub 8. I think that's now becoming quite clear. And again, the leading indicators are suggesting that growth is going to stay pretty sluggish. Very important for commodity markets that, and suggest that the commodity markets declines that we've seen will continue for the time being.
Glyn, in light of that, we've spoken a number of times recently about maybe the markets a bit ahead of themselves.
Yes.
Do you have a feel for what we expect in the shorter term?
Well, we've got these two competing forces. The liquidity that's clearly underpinning markets, the fact that activity globally in the major economies has weakened off and looks to us as if it's going to stay sluggish through the next few months. The fact that it's weakened off, it clearly means that central banks are going to remain with very loose monetary policy for longer. I think we can now with confidence say that we can look forward over the next 18 months to very, very loose monetary policy, lots of liquidity around. The ECB, European Central Bank, is meeting today. I think there's a very good chance they'll cut interest rates by 25 basis points to 50 basis points. So we can look out for a long period ahead of loose monetary policy. Against that, of course, we've seen this weakening in the economic fundamentals, we've had a situation where markets have risen very sharply over the past 6-9 months. MSCI World is up by 25% or so. Japanese market, which has led the way in recent months, up by 50% since the lows late last year. There is no doubt that the economic fundamentals, to some degree, suggest a pause here, and I think we need to see the fundamentals begin to pick up before markets move on again. Medium term, we remain positive about markets. We think that the fundamentals will begin to improve as we go into the latter part of this year and into 2014. We know we've got this huge liquidity underpinning, but I think a period of consolidation, some slippage in markets is overdue here, and wouldn't be at all surprised to see the next few weeks the markets go through a period of sort of patchy performance.
Thanks, Phil.